Tonight, investors are reeling from a market meltdown and wondering what happens tomorrow morning when the opening bell rings. The Dow plummeted more than 1,000 points, suffering its worst day in nearly 2 years. The Nasdaq and S&P 500 lost 2.5% to 3% of their value after a perfect storm of negative news. Friday's disappointing jobs report, the Fed deciding not to drop the prime rate, and now growing fear of a recession. The volatile market has made some people anxious about the state of their investments and financial future. But Jason Wheeler shows us why now is not the time to panic in tonight's Right on the Money report.
As the stock market has risen in recent years, lifting my investment accounts with it, I've been able to rest a little bit easier and think maybe I will be able to retire someday. There have also been those days that have just slapped, causing me to get way overconfident and think maybe I'll be able to retire today. But then there are those cringe market days, including a few of them lately, where I've just had to get up so that A, I can keep working, and B, I can free up my pillow, allowing me to hold it and scream into it. See, that way no one hears my pain. And it's even better if it has my special pillowcase on it with this illustration from JP Morgan. They figured that if you invested $10,000 in January of 2004 into the S&P 500 and your money followed the gains and the losses of that index, your initial $10,000 would have been worth well over $60,000 by January of this year. But if you had pulled your money out of the market from time to time and missed out just on the 20 best days in that entire 20-year period, your initial $10,000 would have been worth less than $20,000 by the start of this year. So you might be thinking, why would I have pulled my investments out for the best days anyway? But JP Morgan notes that in those 20 years, 7 of the best days came within 15 days of the 10 worst days. So big loss days sometimes happen really close to big gain days. Now, since we're looking at market history and this is a presidential election year, a powerful argument for you to not quit the markets if your candidate doesn't win. I don't actually know of anyone who would do this, but there's another slammin' chart that's about this, and so we're going to take a look at it. Charles Schwab also used the S&P 500 for this and went all the way back to 1961. They figured if you only invested under Republican presidents, an initial $10,000 would have grown to about $102,000. Their math found that if you only played the market under a Democratic president, your $10,000 investment would grow to about $500,000. But here is the big takeaway. They reckoned that if you stayed in from 1961 through 2023, no matter whether the winner was from the party of the elephant or the party of the donkey, you transformed $10,000 into more than $5 million. So maybe you separate your politics from your investing habits, and remember, just keep your pillow handy because you can always scream into that if the election outcome isn't what you wanted. Now, the charts today assumed that investments were in something that matches the S&P 500. So some info on that in my article today posted at Jason Wheeler TV in all of these places to help you hopefully invest and then rest right on the money.
And here's another reason to be optimistic. Despite that massive drop, the Dow is still up nearly 1,000 points from where it started the year. And it is noon right now in Tokyo. And when the markets opened in Japan, their benchmark start soared more than 10% just one day after posting a near record loss.